Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. We are going to be answering your questions about retirement planning, asset management, tax planning. You can send those questions in now. You can send them to Ask Tom at talkmoneywithtom.com. You can put them in the chat. You can send them in during the week so we have a chance to prepare for them. But that's what this show is about, just trying to help you get better at learning finances, especially around retirement. And really, it doesn't matter whether you're 20 or 80, already in retirement or looking forward to it. A lot of the things we talk about apply to most groups, actually. And so send them in. We're happy to answer. Love to answer them live. Try to stump us here and see if we can get some questions. So obviously, we believe that, the education of our clients and of the public in general is important in this area. I feel like this is kind of a missing piece, so you can subscribe to the channel. You hit the subscribe button. There's a little bell that tells you, every time we put something new on there, you can hit that also. Or you can just set up an appointment to talk with Ethan and I. We have a book appointment button on our website for our business. The link to our business website is here on the YouTube channel. Button looks just like it does here on the screen. You go up there, and we have our schedules online. You can pick a half-hour time to meet with us and chat about your specific issues on a customized basis and see if we can help. So really looking forward to today's show. We've got some good questions that did come in already, and we always cover questions that come in during our client strategy sessions also, so we're looking forward to that. Always start off the week with a summary of what happened for the week, right? Start off our show here, so let's get into that. All right, so this is probably capping off, it looks like, today, maybe the fourth week in a row of down, right? September was down 5%, it looks like, up to yesterday, and might be down a little bit more today. And we talked about, in July, that we were going to have some type of consolidation period, right? Or we felt that would happen, just because there was such a run-up and such a stretch to the upside. And so this is what we're dealing with. I know it's a little bit painful and what have you, but this is how we get to the next level if we're going to go to the next level. In my opinion, in order to get to a new high for the year or a new all-time high, which we set back at the beginning of last year, we need these kind of consolidation periods to clean out, some of the, overvaluation issues, let earnings maybe catch up. And more importantly, I think, is really to get down to a level that people say, wow, I really want to buy that. And then it kind of gets that momentum going. And so what I'm looking at, lots of different things, but I talk a lot about support and resistance because I think it's a very important component of kind of understanding what's happening. And so, early this week, and even on the last show, we were talking about, kind of felt like we would break through the 4,300 and come down. And so we have done that. And we're down here, and I've drawn a line across. This is, roughly a year and a half, a little bit more, year and 3/4 worth of, pricing on the S&P 500. And what you're looking at there's a little bit of support here, and we're kind of bouncing around this week right around here. And you can see how many times we were around this line before. One of the biggest ones is that big triangle there that was last summer, and not a ton of support there, honestly. And we came up this year through this level quite quickly. So the current support that's more, near to our date here that we're doing isn't super strong. And again, support is, the idea is, hey, a lot of people bought at this price. It went up. They're excited. They made money. And if it comes back down to that price, they might buy it again, right? And try to do that. And so here's where I see the biggest support over the last year and a half, and there's quite a bit of action in this line. This is kind of that 4,200 to 4,100 range, give or take. And again, doesn't have to be exact. You can see it doesn't always hit everything perfectly, but the idea would be that it gets into this range, which is where I think it's going to go, and then it stimulates some buying, and then that gets all of this short interest to start to cover their shorts, right? Because the short interest right now is quite high. People are betting that the market might fall. And then you get this situation where, those people, the market starts coming up, they start to panic because you can lose an unlimited amount of money shorting stocks. So in order to cover your short, you actually buy the stock back. And that just creates more upturn, right? And so that would be kind of the idea behind how this could turn around. And that's how most of these have been going recently, once we do get an upward movement. And then that short interest there, and then everybody starts getting excited, and the public starts jumping in, and fear of missing out. And all of a sudden, we're back to a new high for the year, or, you know, maybe next year, a new all-time high. So that's the idea behind this. And so I do think that, you know, we're going to have a little bit more downturn here into that level. Last year we fell in September. Last year we fell all the way through till October 13th when we hit our low. And we're repeating a similar pattern where the peak is happening, you know, in the summertime, and then we're kind of coming down through October. But we had a decent finish to the year altogether, although the last 2 weeks weren't great, but otherwise it was pretty good, especially from that October low. So one thing interesting that we're facing right now is that the government might shut down, right? Sunday essentially is when it would shut down. And there's all kinds of different things. It's very fascinating when you look at what's going on there, because like air traffic controllers are super important to the travel industry, obviously, and to really to world commerce. And so they historically have been asked to come to work without pay, which is kind of interesting. And so, you know, there's all these different pieces that are out there that are really important. And it's kind of sad that we might end up doing this again. However, here's a list going back to 1976 of all the government shutdowns that we've had and the impact on the stock market. I know this is a little bit hard to read, but look at the totality. First of all, it's happened more than once.
Yeah, it's happened quite a few times.
There's a few things I noticed on this chart that are kind of fascinating to me. Number one is the average rate of return for the week before, down 0.4%, right? Okay, the average rate of return in total over the whole time that the government was shut down is actually up 0.1%, right? And so not a lot, right? But the other thing that I noticed on this chart, and again, this is hard to see, if you look at the top, it's negative 3.5, negative 2.5, right? There were bigger impacts at the beginning than there has been recently. Matter of fact, the last one, the market was up 9.4%.
Yeah, and that was the longest one ever.
It was the longest one in history. There were some reasons for that. The Fed was actually lowering rates in that time frame and such too, or at least talking about it. So, but what's important is sort of like the debt ceiling. You know, the first big debt ceiling argument in 2011, market dropped 17%. This big debt ceiling argument that we just had this year, I think the market from high to low was down about 3%.
Yeah, and most of these shutdowns are, you know, a couple days. They don't tend to run very long.
Yeah, because it becomes more and more political pressure, you know, because there's people not getting paid. There's people living paycheck to paycheck that aren't getting paid. And, you know, you can push on this for a while, but over a period of time, and I remember during that 35-day period, the pressure really started to ratchet up. You could see it. So, yeah, I don't expect that this will last too long. But today was a good day. The market was up. And now it's down, right? And I think part of that's because of the shutdown. People don't want to go into this weekend, you know, the traders, you know, they don't want to be long. They don't want to be in the stock market. They'd rather sit out the stock market for now, you know, prior to this weekend shutdown, just in case, you know, if there's something that goes on. Because the news we got today I thought was pretty interesting. But we'll hang on, one more subject first. But so crude oil is one of the other issues that gets talked about all week. We saw crude oil run up this week. We saw it come back down. However, this is a long-term chart. We used this chart on the last show for a different question. This is going back to the 1967 time frame. And this is logarithmic chart, which just means it's sort of showing more percentage motion than price motion. And so it's a little bit more relative. But if you look back at the late 60s, you know, early 70s, and early 80s, that move was unbelievable. It went from $4 to $41 a barrel, went 10 times, right? Yeah. And here we are at $90. It's been at $90, or we're at 90-ish. We're at 95 at one point, 92, but it's been in that range a lot. You can see that line drawn across there. That's a place we've been able to function as an economy and what have you for a long time. It's disturbing that the price of oil is up 35% since, you know, June, right? So the trend is wrong. But in order to have an impact like we had in the last massive inflationary spike, you need to see oil do something like it did then, possibly, and that's kind of outrageous. I mean, it would have to go to $900 a barrel to have the same type of impact that you've got here. So not too likely. That was a big impact, and rightfully so. So, but here's the other, I think, the good news piece here, and this is reported today. So the last day, business day of the month, we get PCE. Now this is probably the most important number that comes out for the stock market right now, maybe besides oil price, at the moment, is this core PCE. So this is an inflation measure called Personal Consumption Expenditure Index, price index. And this is the favored measure. Chairman Powell's talked about this several times for the Federal Reserve. And when they're talking about getting down to 2%, right? This is what they're talking about, getting down to 2%. Not CPI, not top line inflation, which includes food and energy, right? But core inflation on PCE. And so that's reported fairly late. So this is actually for August. We were the last day of September. And this is actually one of the things that could be affected by the government shutdown, because today's the last day, business day, that the government might be open for a little bit. And the department that makes this report might not be open to make the report for the next month, or maybe get behind, or depends on how long the shutdown. If it goes 35 days again, we're going to go right past the next Fed meeting, which is November 1st.
Yeah. And so all the regulatory bodies won't report data or any kind of information because they're on shutdown. Yeah,
that'll be kind of fascinating. It is, according to the articles, enhancing the probability that the Fed might not do anything in November. That's part of the bet that's happening there, because if they don't have data visibility, they might just sit on it and wait until December meeting. So, but here's the important part about this. This is the month-over-month change. So if you see that 0.1%, so that was how much inflation changed on this basket of goods for the month of August versus the previous month, which was July of this year. And so what's important about this is the last 3 months, this is rounding, 0.2%, 0.2%, and now 0.1%. So first of all, last time we had 0.1% was the last time inflation was really low, which was back in, if you look back here, November of 2020, way back at the beginning of this chart. And number two is, if you kind of annualize that, that comes out to right around 2%. It's rounded. It's probably closer to 2.2% when you take out the rounding. But that's exactly the number they're trying to get at. So we're on track for the last 3 months, right? And you were saying something about for the last 12 and 6 months.
So the last 12 months, it's 3.9. The last 6 months, if you analyze it, it's 3. And so you can see how it's slow. It's been coming down steadily. And so that's what the Fed is really looking for, is this. We want to come down, but we don't want to come down too fast.
So this is the most critical piece of information, because the most critical thing for the stock market, in my opinion, is what the Federal Reserve is going to do. So they've raised rates quite dramatically, right? We are seeing some impact from that, whether the rates caused it or not. Nonetheless, inflation is coming down. The core PCE inflation is coming down, right? And that's important. And so then what that does is, it allows the Federal Reserve to say, okay, maybe we don't need to raise rates. And the reason we bring this up is because the last 2 big downturns were caused, in my opinion, by the Federal Reserve over-raising rates. 19 rate increases before the 2000 downturn. That was a 45% downturn. 21 rate increases before the 2008 downturn. That was a 57% downturn from high to low. And so here we are. This is important, to be able to let the Federal Reserve back up and say, okay, we don't need to raise rates anymore. We're going to let this play out, because if we wait another 9 months, we might already be at our 2% target, right? So that's important. Now, we'll have to see what happens to the price of oil. We'll have to see, other things, because oil is taken out of core inflation, but you can't actually take oil out of anything because it's in everything in the end. That's why we always talk about it as far as that goes. But so the market is now predicting no rate increase. This is from the CME group, their Fed Watch tool. So this is a conglomeration of the futures market that's out there. 82% likelihood of no rate increase. We'll stay at 5.25 to 5.5, which is where we are now. That was just a 50-50 flip about a month ago. And again, it's because we're seeing this other data come in, and maybe even because of the shutdown, problem that with the data, they're saying maybe nothing in November. but it's still a 65% probability of no change in December. Okay. And then if you go all the way across all of the different Fed meetings, there's kind of tabs up on top there. The next time you get a change isn't until we get to June of next year. No, July. I was right. Sorry. July of next year. The projection is they'll actually be lowering rates. The majority of those bets are below 5.25 to 5.5, right? So that's actually a really good thing. If interest rates can stay stable, if inflation can continue to do what it's been doing for the last 3 months, if the Fed doesn't do something dumb and raise rates when they don't have to, in my opinion, then I think the market could respond quite healthily to this, because it is one of the big drags on it. Certainly been a big drag on the bond market. But if we look at what the Federal Reserve is projecting, these are the dot plots from June, which is the blue, and September, which is the purple. So each one of these dots represents a Fed governor, and it's their projection for what they see rates being at the end of that year, right? So if you look here, 2023, we're at 5.25 to 5.5. There is a majority of the Fed governors from the September meeting that think we're going to go up another quarter point this year to 5.5 to 5.75. They always use little ranges. And that actually increased. If you look, from June to September, there's more people in the federal governors thinking it's going to go up. So that's a disconnect with the market. The market's predicting zero. And so whenever the Federal Reserve is running around out there saying, hey, we're going to raise rates more, and we're going to keep them up longer than anybody expects, that doesn't help the market. And I think that's by design. That's exactly what they want. When the market goes nuts like it was doing, prior to the 31st of July, you get the scenario where people feel like they can really spend money. And that, of course, is what they're trying to fight in an inflationary fight. But here's my main point for throwing the slide is 2024. If you look at all those blue and purple dots, most of them are below our current rate. So the Fed is doing interviews right now saying they don't think they're going to be lowering rates, even maybe next year. But when they do the dot plot in the statement of economic projections, and they have to put their projection out, they're projecting as a group, as a majority of the group, that they're actually going to have lower rates next year. And that's exactly what the market's saying too, in its bet also. So I think things are lining up here to be possibly a bounce off of this level, this 4,100 to 4,200 level. Oil prices are high. See what happens there. Government shutdown historically doesn't have a huge impact, so hopefully that's true this time also. And then the PCE number, the inflation number today, gives me great hope. I mean, that's a really good number. And they reconfirmed this week the GDP growth for the second quarter was 2.1%, right? Because they put it out and then they revise it. And sometimes it can be quite different. But it was 2.1 and 2.1s, which was good. But the main thing is, for me, 2.1 is a good number. That's a soft landing number, right? I mean, you don't want negative because that's a recession. 3.4, I think, is our longer term average, something in that neighborhood. And having it at 2, that's some restrictive growth, they call it slow growth. That's a soft landing. That's perfect. That's exactly where you want to be to kind of bring inflation down. It has been, I think GDP is trending a little bit towards the hot side. And Chairman Powell talked about that at the meeting too. So they're looking at the GDP as well as the PCE, well, a lot of acronyms, but nonetheless, right? So that's important, but that's what's happening right now. I think this is a really fascinating time frame. I think we just need to have some patience. There's some opportunity here, I believe. The bond market is down a lot. There's going to be some opportunity in the bond market at some point here, and we're looking at our signals right now are red for the stock market. Obviously, we're going through a situation where the market is down, and I still think it'll go down some more before it kind of hits that level. We're double red, fast and slow, and then our signals for the stock bond markets have been double red for quite a while, and we've been out of the bond market. Now, we have two different trading systems. When the 50-day moving average is above, we basically just roll out of positions as they fall below a cut line on our list. So we have 175 ETS, and we'll hold in there. And so if it falls below our cut line, and our cut line is custom, we redo that on a quarterly basis. And we'll move to the next one that's at the top. And so we've been moving out of technology because it's moving down and into more things like consumer discretionary, financials, and those types of things. But the bond market is a different story. When the 50-day moving average is below the 200-day moving average, we have a more aggressive move because that's now in a downturn. Mm-hmm. And so we will move to everything that we have in our targets to whatever's at the top of the list. And right now that's T-bills.
Yeah,
right?
short term.
Very short term, less than a year for the most part. And so we've been in T-bills. That's worked out really well. We're killing the bond market by not losing money in that area at the moment for the majority of our portfolios. There's some cases where we have to stay in because of large capital gains in different situations. So I'm giving kind of the broad view of the overall, models that we manage. So, but that's important to understand right now. Even though we're double red on the stock market, I still think there might be some opportunity here when we get down into that level. Now, one of the things is everybody's talking about the same thing. They're all talking about that same level, right? And so we might not get there. If we're going to have a rally, we might not get there because everybody starts to jump in early knowing, hey, now's the time to kind of buy into this. But we'll see, see how this plays out. This will be just a few more weeks and we'll kind of know what's going on, in my opinion, and see what happens. And hopefully that generates this short covering and a longer term rally that kind of takes us through the rest of the year too. So, and this is the last day of the quarter. We've had a lot of end of the quarter issues where the market sells off, and then sometimes even the first day of the next quarter it'll start to move upward again. So let's see what happens next week. But I think with the shutdown happening, that might put a little damper on people's risk appetite for a little while. There is a little bit of a differential in this particular downturn because Moody's is talking about, this particular government shutdown, because Moody's is talking about reducing our rating from their highest rating to their second highest rating. Yeah. We've already been knocked down by the other two rating companies, Fitch and S&P, and so that's going to certainly going to have an impact on the bond market, and it already is as far as that goes. So anyway, we'll see how. Hopefully they can avoid that, do something, but it's not looking real positive, as far as the shutdown at this point. So, okay. Good. Thank you very much for watching the summary. Look forward to being able to talk to you again about it next week. All right, let's start off with our questions.
How do I compare municipal bonds to taxable bonds? Because municipal bonds have a tax-free element to them.
Yeah. Okay. So, obviously there's all kinds of different municipalities that issue debt. And one of the things that they try to do to make you buy that debt is to offer it as a tax-free growth. But they often pay less. So there's kind of a factor there you have to consider. And so first of all, let's share how you calculate it. So you can do what's called the taxable equivalent yield, right? So you take your yield from a municipal bond, whatever that is, and you figure out your tax rate, and you do 1 minus the tax rate and divide into the yield, and it'll tell you what that is. And so there's another table here provided by Hartford funds. Kind of cool. Shows for different across the top there 1.5, 2.5, 3.5, 4, 5.5 on muni bond yields. And where are they at right now? Would you say?
About like 3.5 to 4, depending on like the credit worthiness. And so you'll get the equivalents kind of toward. It depends on your tax rate, but it's very comparable to a treasury bond.
Yeah, if we look at 3.5 and you're in the 10% bracket, if you can get 3.89%, right? And it depends on, single or married, and 3.98 to, for the 12%, et cetera. But you end up, that's the same return, right? Even though you pay taxes. But if you go down the list all the way to the maximum rate, which is 40.8%. That's the 37% plus the 3.7%.
Net income.
ACA, what do they call it? Net income tax.
Yeah.
Yeah, it's to sponsor the ACA, the Obamacare, whatever you want to call that, and that is equivalent of 5.91%. So, if you go out there right now and you wanted to buy, let's say, a 2-year Treasury. You're not going to get 5.91% today. So you might be better off with that municipal bond, at least on a taxable basis, at 3.5 if you're in that higher bracket. So it makes a difference what bracket you're in as to whether or not it pays off.
And then sometimes with municipal bonds, for California as example, if you buy a California municipal bond, you don't pay California income tax on that. So
Yeah.
if you're trying to get an equivalent rate on that, you have to add your federal tax bracket and your state tax bracket together to get, and then do the calculation.
Yeah.
So that can kind of change, but it varies on state to state. Depending, most states, if you're buying within them, if you're a resident buying within your state, usually it's tax-free for your state income tax.
Yeah, double tax-free basically is what you're looking at there. And yeah, and so, but there are some other considerations. And one of the things that I think is really important to understand is taxes are only part of the issue here. The equivalent rates get pretty close. I mean, it's kind of interesting. I think right now munis are probably a little bit of a premium over what you can get on the taxable side. However, there are things to consider outside of that. So you have to be careful here. First of all, what's your tax bracket? Does it make sense? Let's say it does. Let's say you're in a higher tax bracket. Now you're looking at what you're doing with your overall portfolio. Because, for example, in 2008, and again, I'm looking at this for somebody that's retired, right? This is important to understand. In 2008, there were several municipalities that defaulted on their debt.
Yeah.
Right? And so if I had a choice between buying a treasury that had a slightly less yield after tax versus a municipal bond, I might buy that treasury, or at least I would mix those two together, because when 2008 happened, municipal bonds fell much more than treasuries did.
People don't run to municipal bonds like they do to T-bills.
That's right. And during the 2020 downturn, what went up? Not municipal bonds. They actually went down. There was some fear for what might happen there, and treasuries went up. Right? And so that's what happens, that you don't have the same parachute effect with a municipal bond. And so be careful, because the money that you're going to make in your life is going to come from stocks and real estate. And the bonds is kind of a placeholder, a thing to use to, not have everything in stocks and real estate, a diversifier. And it can have an exaggerated effect of being able to go up when the stock market goes down, right? Doesn't always work. Didn't work last year. Bond market went down. So in inflationary environments, that doesn't work, right? And so, matter of fact, real estate, I don't know that it went down much, but it struggles even then too. All three of those classes when you get this high inflation, because they're raising rates so aggressively. But it's a good question, and it's good to understand how this works. I would not, even if I was in a higher tax bracket, be pumping most of my bond money into municipal bonds. First of all, you have other accounts like Roth IRAs and regular IRAs and 401ks where you can't use municipals anyway. But on my taxable accounts, I'd still be looking very carefully at my overall allocation to munis versus regular bonds, especially government bonds, because I look at the bond portion of portfolio not so much for a return, but just more as a protection asset for the stock market side. That's just my outlook on it, and it's been that way for a long time. But it's a good question.
Where should I be saving for long-term goals? I'm not exactly sure about the amount of money I need, or I have a rough idea of the time frame. So 10 to 12 years, but I'm not 100% sure.
Okay, so where to save, it makes a big difference is in terms of the timeline. So that's where the timeline does matter. So, I mean, I'll share, the little slide that we found here. So this comes from lazyportfolioetf.com. They do a really great job with some of these charts. What this shows is kind of the best and worst 1 year, 2 year, 7 year, 10 year for the stock market going over the last 30 years.
Yeah.
Right. And so you can see, if you don't know your timeline at all and it ends up being 1 year, you're taking a tremendous risk popping money into the stock market. You could get lucky and get the blue side there and make a bunch of money. You could also get very unlucky and lose a lot of your money. But time starts to eliminate risk with the stock market.
Yeah, it kind of returns to the mean.
Yeah, exactly right. And you can see that, here at about 15 years, at 10 years, it's just a small loss, that happened once, and much higher gain, right? And you start to see that skew going towards the blue side as you move down, right? And eventually, if you have enough time you're pretty certain to be able to make some money in the stock market. There's going to be some scenario where that isn't true, believe me. But your investing is about probabilities.
Yep.
That's what it's about for me. And I always look at probabilities. What's the probability of this working out? So if I had a goal, like you just mentioned, a 10 to 12 year goal, I would have a majority of that in something like the S&P 500 or the stock market or diversified portfolio. If you're starting with small dollars and just saving, then one
dollar cost averaging.
Yeah, one ETF, Vanguard Total Stock Market Index, or whatever it might be. Depending on what that goal is, if you're going to feel like you're going to have to liquidate that whole thing, I might ratchet that down in terms of stock market exposure, much like we do with the 529 plans for college. So
when they're babies, you're super aggressive, but when you're like about to enter college, you dial it down.
That's right, exactly. You could be 100% for a 2-year-old and 20% stock market exposure for a 16-year-old, right? So same thing here. As you do define the timeline, you might dial back that stock market so that you don't end up with one of those negative 43s right before you were about to spend that money on whatever it is you're going to spend it on, right? So that way, you're preserving most of your principal that you've made in that time frame, hopefully made.
So you would target this in like an after or taxable account. So you wouldn't be looking at your 401ks, your Roth IRA, or your HSA or 529s. You're looking for something that you can easily liquidate without any kind of complications.
Yeah, it's a good point. It's not just like where you invest it in terms of stocks, bonds, real estate, whatever. It's also what type of account. So taxable account, brokerage account, everybody's got different names for it, but it's just not an IRA, it's not a Roth, it's not a 401k, etc. So because all of those might have a penalty, they'll all be taxable when you withdraw. You won't have a capital gain. You'd rather have a capital gain tax that's lower than ordinary income for most people, that type of thing. Hopefully it stays that way. But anyway, it's a good question. It's interesting to look at and see how that plays out. But this is always something to remember in general about investing, is that you should have a timeline. If you look here, 5 years is pretty good. I mean, when I'm looking at this chart, 5 years, I'm starting to get a pretty good skew towards the blue. So that's a pretty good, minimum. Make an argument for 3 years. Again, pretty big skew towards the blue, bit more aggressive. But if you don't have that kind of timeline, if you aren't thinking in those chunks of time, even with your current investments, because a lot of people say, I lost money last month or over since the high of 2022 or whatever it was, it's still, you're not thinking in 5 and 3-year chunks. And that's what you need to think about with the stock market, because that's how you make money, is by having that patience.
If you're sub 2 years for this goal, always cash. Or like you can do CDs, you can do any kind of money market, but something that you're not going to lose money on.
Yeah, exactly. It's usually not worth the risk otherwise. All right, what's our next question?
Can I still work while receiving Social Security benefits?
That's a good question. So I used to do, seminars, as I've mentioned before, on Social Security maximization prior to the pandemic, closing those down. But and this came up quite often. So if you still want to work and get Social Security, it is possible to do, right? Yes. You can make, and this changes all the time. We looked this up for this question because this came in earlier. It was $21,240.
Yep.
So if you can make up to that amount and no impact on Social Security. If you are at your full retirement age, right, which right now is going to be between 66 to 67, depending on your age, you can earn as much as you want. So this is only for those people between 62 and their full retirement age that decide to work and take Social Security. Okay, in that group, you can make $21,240 with no impact to Social Security. It just keeps on going. It's like you weren't working. If you make more than that, for every $2 that you make more than that, they take away $1 off of your benefit for Social Security. But here's the rub there that I think is important, is you don't actually lose it. You're not losing that Social Security because you're actually potentially adding to Social Security still by working. And so you might have a higher Social Security amount once you do stop working or once you get to full retirement age or whatever it is, than you would have without that work. So I personally wouldn't worry about, trying to stay under those levels, or you're not losing anything. If you could make 40 or 50 and decide to make 21,000, you just let a year go by that you could have made 40 or 50, and in an attempt to try to do something weird with. So I've seen that all the time. People twist themselves into knots.
And the thing is, it's 2 to 1 reducing
Right.
your benefit. So if you lose $1, you're still netting one extra
Yeah,
dollar.
keep working if you want to work. Don't worry about what you earn. You know, it's you know, I probably wouldn't take my Social Security if I was going to make money. But sometimes people have already taken it, and then they got a different opportunity that came up, and you know,
Yeah.
so yeah, you know, too hard to stop it, so they just keep going, right? So, but it's not something to really be too concerned about. It's good to know how it works. But I think one of the misconceptions is that people feel like, oh, I'm losing money by making more, and that's not true. And so, you know, don't worry about making more if you have that opportunity or want to. Yeah. Good. What's our next question?
What are the pros and cons of buying single issue bonds versus a bond fund or ETF?
Pros and cons of buying single issue bonds versus a bond ETF. Okay, so one of the things, you know, from a practice standpoint, and it translates, I suppose, to an individual standpoint too, it's a lot more work to buy an individual bond than it is to buy a bond ETF, let's say. It said bond fund, there's mutual funds, and there's bond ETFs. We use ETFs, they usually have less expense. They trade for zero cost for us on the Schwab platform, at least zero commission anyway. And then they, you know, can be traded during the day instead of just once, like a mutual fund trades once at the end of the day. So I'll compare a bond ETF to a single issue bond. So when I buy a bond ETF, it's pretty easy. And I buy one thing, I can buy the Vanguard Total Bond Market Index right now. I think there's 7,400 different bonds in there. I'm getting a diversification that I can't possibly get by buying single issue bonds, right? Because even if I buy single issue government bonds, I have to decide on the duration. Is it a 3-month, 3-year, 30-year, you know? And any one of those durations could have a hit one way or another that might not be what I expected to happen, versus if I own all of them. And basically now I'm just looking at the higher level issue of what's happening with the bond market instead of what's happening with my 10-year treasury. Does that make sense? So the diversification potential is much higher. Now, the big advantage of a single issue is that it has a due date, and it has a maturity date. And so if I buy a 10-year treasury, it is going to get back $1,000, par value, $1,000. So if I bought it at issue, I paid $1,000. I get my money for 10 years, and then at the end I get my $1,000 back. Right? If you buy it on the secondary market, you might have bought it for more, 1,100 or less, 900. You're going to get back 1,000. Right? So that's how it works. Now, an ETF just keeps rolling. Inside the ETF, they're getting those same scenarios. As those bonds come due, they get back their piece. But your experience with that ETF, you could have at the end of 10 years less principal because of the price depreciation in the overall bond market. And so there's some advantages to that. It's sort of like a CD, you know, same thing, you know, in the sense that it has a maturity date and you kind of get your money back.
So the thing with single issue bonds is you lock in a rate. So if you lock in a rate high and the market comes down, you're doing great. With a bond fund, it'll slowly ratchet up as they cycle in new issue bonds. Their rates will go up, and so that's a good thing and bad thing. But you also have to research who's the underlying issuer of the thing. Do you trust them? Are they going to be around for 10 years? It could be a company, it could be a municipality. You have to figure out, you know, how do I evaluate? And so there's a little bit more effort goes into a single issue bond versus a bond fund.
Yeah, exactly. So again, if I can go at BND is the ticker symbol for Vanguard Total Bond Market ETF, right? I can go buy that. It has a few holes. It doesn't have high yields. It doesn't have ultra short-term bonds. It doesn't have tips, right? But it has just about every other type of bond out there. And so when you're buying single issue bonds, now you're having to decide, well, okay, I could just buy government bonds. Pretty easy. The research isn't that hard, but it might be a period of time that corporates are doing way better than governments, right? And so you won't have those if you just bought treasuries. So, okay, now I'm going to buy some corporates to put in there. Now you're getting into a whole different ball game of analyzing that corporation and their ability to continue paying you, right? And so now you're getting out into a credit risk arena that is mitigated dramatically with 7,400, 7,500 bonds in one ETF. Does that make sense?
Yeah.
So that's important to me too, because I'll tell you what, I've never had a situation of a default for something that we recommended, mainly because we don't do a lot of single issue things. It's very difficult to do across 1,000, 2,000 accounts to do these single issue bonds and get them distributed right and those types of things. It's not impossible, but much harder than buying ETFs for us. But I don't have default risk. I do not want to be sitting in front of a client and say, hey, we bought XYZ company. They just defaulted on all their bonds.
Especially when you're buying, each of these bonds are $1,000. So you could be buying $50,000 of a single issue bond, for example. And if they default on that, your money's gone. Yeah,
exactly. So that's why you got to be really careful with single issue anything. And that's why we like diversification. I like extreme diversification. We almost always in our models have thousands of bonds and stocks involved in these ETFs. And I'd rather focus on the overall market conditions, because once I get down to single issue, I have to focus on the overall market conditions plus what that issuer or individual stock or whatever it is, what's happening with them, right? If I get that right, I can make more money, but it's much harder to be right.
Yeah.
It's easier to be right about the overall market and look at that. And so I look at massive classifications of the overall market, technology, financials, and some segments that we'll use, but I don't dig down very often into the single issue area, just because, again, the volatility picks up, the diversification drops down, and the chance for default or, catastrophic problems. There's some great companies that have had huge downturns. GE went down 90%. GE, original Dow component from 1883 was down 90%. They're doing better now, but still, right? It's one of those things where if a company like that can have that kind of a downturn, we're looking at 3M, another fantastic company, has had a big run down, about a 50% run down from high to low.
Yeah.
And so that's why I like that diversified portfolio. I don't have to worry as much about those types of things. And it's a little bit more, in my opinion, a little bit more certain of potential gains going forward than some of the single issue stuff. So it's a really good question as far as that goes. All right, looks like we're pretty much wrapping this up today. I want to thank everybody so much. Those were some good questions. That was kind of fun. I'm enjoying all these. Send in your questions. That's how this show goes. Help us out here. Feel free. Anything you think of, something comes up in your daily life you've been wondering about, and you want to get some, a breakdown on that, maybe some visuals, and we'd be happy to do that. And you send them to Ask Tom with talkmoneywithtom.com, and we can see them, during the week. Again, we'll be here next Friday, so we can try to answer those by then. Of course, subscribe to the channel. Continue your education here. There's a lot of resources. We have been doing this for a really long time, longer than I care to admit. And this is going to be something that I think would help you tremendously. Even if you have an advisor, the more that you understand about retirement planning, asset management, and tax planning, the better you'll be, at least financially, in your retirement. And of course, you can meet with us. And that's available on our website. Book appointment, button up on the corner, just like we said at the beginning. And you can set up a 30-minute time to meet with Ethan and I, and we'll be happy to meet with you and discuss your situation kind of one-on-one. So thank everybody coming so much. Look forward to seeing you again next Friday. And thank you very much.